watch this again, you guys, especially if you are newer to trading options. I mean, even if you have been trading options for a few years now, you are probably going to have several takeaways here. And some of those takeaways may be missed on you the first time. Another thing, I came from a psychology degree, so the second time through, it sticks to your long-term memory, you guys. First time through, it's going to seem like, oh yeah, I got this. I'm never going to forget any of this. Well, then in a couple of months, you're kind of like, wait, what did he say? What's the width that how much collection do I need? All of those little things will stay in your long-term memory better if you watch it again soon after the first time going through it, okay? So even if you think you got it, watch it again just to make sure that your brain keeps it in that long-term memory, all right? So without further ado, this is options for intermediates too. Now, if you guys have been following along with this, we did options, beginner, intermediates. That really was intermediates 1. This is intermediates 2. So we're in the intermediate phase where we're going to kind of be stretching it out to where we get into advanced strategies here. So with the intermediates 2, there's going to be some premium selling strategies, which is considered to be a more advanced strategy, believe it or not. I feel that it is appropriate for everybody, but I want to make sure that I'm kind of going with industry standards somewhat. At the end of the day, your probabilities of success with premium selling strategies are a little bit better than they are with premium collection strategies. So why would that not be, you know, suitable for just about everyone? Well, there's other reasons, but to follow along with industry standards, in a sense, I've moved this out to intermediates too. So this is a little bit more of an advanced concept, and there's going to be some differences, nuances that I talk about that you're going to find online. Yes, you can find these strategies online, of course, but they are just going to tell you how to set it up. They're not going to tell you why you set it up this way and when and where, what the duration is, all of those little nuances that are very important to us and our success in trading. So I'm going to go through a lot of those things, and believe it or not, I mean, I've seen the mistakes and I've done the mistakes. You know, when I was trading on the floor, you guys, I didn't have the opportunity to pick and choose what strategies I was trading because I was a trader and I was expected to trade just about anything that was offered in there to create that market. But anyway, let me get a couple of things out of the way real quick. My name is Eric Wilkinson, you guys. I've done stuff on CNBC, Fox Business, Wall Street Journal. They actually used to call me the Wolfman. I started trading in college with some money I had earned through middle school and high school. I worked on a family farm, but I did get paid. Some people got to go to summer camp. I got to go to summer farm. Anyway, so after graduating from college with this finance degree, I moved up to Chicago and continued my trading. I was trading in college with some stocks and covered call strategies and things of that nature, but then moved to Chicago, sold all my stocks and everything, bought my badge and started trading from there. So in that time, I've traded everything from stocks, financial futures, commodities, currencies, and basically options in all these markets in just about any market condition you've probably ever seen. So I've traded it through that. Okay, can you use your cursor? Can you? Oh, you can see the cursor. Okay, sorry. I thought the screen was frozen. It might be. It might freeze every once in a while. I was having a little bit of trouble. I shut it down and booted back up right before this because it was acting a little bit funny. So hopefully it's working out. Statistically, farmers make some of the best traders. I completely agree with that. I absolutely agree with that. Those guys are smart cookies, that's for sure. And as a matter of fact, I moved up to Chicago to work in the options room, talked to my dad, my grandpa, and was like, hey, you know, I'm going to move up to Chicago. I'll hedge the crop. Well, it was a 300-acre farm when I was growing up. That seemed pretty darn big. Well, when I got onto the floor of the Board of Trade, I realized that was not a very big farm, and I was not going to make a living hedging 300 acres of corn or soybeans. So I actually moved over into the bond room and started working the 10-year options because I wanted to trade options, then moved into the Fed fund futures. It was basically one of the cheaper badges and I could afford it. So it was the path of least resistance and I could still trade it with probabilities as a spreader. And I traded options on the Fed fund futures when they did come out, but it was a long time coming before we got options on our product. Anyway, real quick disclaimer here, please take a second to read over this. All this really says, you guys, is I'm going to be talking about different stocks and stuff like that. They might be in my portfolio. I'm not trying to get you guys to lemming off the cliff. That's the last thing I want you guys to do. I want you guys to think for yourselves at the end of the day. I want to teach you guys how you can be successful in this. So it's not investment advice. It's not a solicitation to buy or sell. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, so you can follow me on Twitter at Wolfman's blog for whatever trading or other snark I can find, but I do throw out earnings trades during earnings season, what I'm doing. I don't say exactly the strikes, but if you guys watch the earnings webinars and stuff like that, you know how I trade, and I stick to those rules. So the other thing you can do is follow us at Pro Trader Strat for some good financial wisdom. Probably not as much snark than I get. Anyway, this is going to be on the short iron butterfly. Now, this is a defined risk strategy, so it is good to get your feet wet with this strategy if you want to get into premium selling strategies, because it is defined risk. Now, it is one of the easier ones to understand. So I wanted to start with the iron butterfly and then go to the iron condor because they build on each other in a sense. So I wanted to start with this one. We'll build to the iron condor, which the iron condor has a higher probability of success, but the iron butterfly gives you the most bang for your buck. All right. So without further ado, let's get on with it. Iron butterfly. What are we looking for? You know, when I go through my rules, one thing we have to come up with is kind of a thesis or a market assumption for the underlying that we're looking at. We're just looking through charts or whatever you're doing, and you kind of come up with this idea. All right, I want to trade XYZ. I don't think it's going to go anywhere. I think it's going to be range bound. And we have high implied volatility, which we want or expect to collapse. And what we used to call it on the floor is you get that volatility crush. They used to get everybody excited when vol crushed. We love the high volatility, but we even love it more when that volatility comes out, because then you get paid off quicker. But we want range bound, high implied volatility in which we expect it to kind of start to collapse. Couple of things when we're building the iron butterfly. What is it? It's a short call spread plus a short put spread. They're at the same, the short strikes though are at the same strike. Or you could look at it like a straddle. We've gone over straddle in the beginners, right? Straddle is the at the money strikes for the calls and the puts. And then you add a long straddle on it, all right, which is that defined risk aspect of it. Sorry, long strangle because straddle is at the money, strangle are out of the monies. The easiest way to think of it though, in my eyes, is it's a short straddle and we're gonna define the risk of it, all right? And this is a great strategy to get in, to get used to or be comfortable with premium selling strategies. Later on, if you start widening out that defined risk, you're going to increase your probabilities of success and hopefully increase your risk tolerance a little bit. Once you start getting, when you get comfortable, your risk tolerance will go up a little bit. But a short straddle with defined risk, I think, is the easiest way to do it. All this other stuff seems to be a little confusing. All right, so our essentials to success, picking the right underlying. We've already come up with a underlying that we're looking at. All right, we're like, hey, you know, XYZ looks like to me it's going to be trading in a sideways market. What could I do to benefit from that? Well, one thing we have to do is check to see if it is a good underlying to trade options. And oh, I'm sorry about that. So a good, I kind of showed my hand here on what I was looking at beforehand. All right, so picking the right underlying, what does that have to do with? Well, the month that is closest to expiration, the monthly, not necessarily the weeklies. All right, we'll talk about the weeklies in a second. But the monthlies need to have a tight bid to ask, meaning my rule for a stock under $100, it needs to be less than, you know, 10 cents wide or less. As you can see with American Airlines, they're about 5 cents wide. That's a good market. That's a tight market. We want tight markets when trading options because that wiggle room, the wider they are, the more edge we have to give up to get in and the more edge we have to give up to get out. And if we have to give up all that edge to get in and get out, we may very well be selling or buying actually, let's just go with selling a strike. If I have to go 25 cents to get filled down, say it's a dollar bid at $1.50 wide, and I have to sell $1.25 to get out, well, that theta decay and everything else might be working out for me. I'm taking a lot of risk. I may have to get out at $1.25 later on. All right. And you're just taking a lot of risk with those wider markets if you really don't know what you're doing. So, and they're harder to get into. Even if you're just working an offer, you might be working an offer to get out for days on end, waiting for somebody to come in. There's just not a lot of participation in there. If we look at American Airlines, when you see these tight bid offers, it is generally going to show you on volume and open interest that there is quite a bit of volume and open interest. We could even look at, like, say, Intel, or we look at Intel, serious volume and open interest in here. Look at all this open interest. That means there's a lot of eyeballs on this market. Open interest means that there's participation. And if you are participating in something, you don't really want to let that out of your sight, right? So there's a lot of eyeballs in here, meaning then if I just give up a penny or two, somebody else is probably going to give up a penny or two here, and we're almost at a match at that point, right? So that's what we want. If there's one person in there trading and he knows he's basically, because he's the market maker, he's the only one in there and sees you come in, he might not move. He's just like, hey, you got to come to me because I'm the only one in the room trading this. I have higher risk because I have to then wait for somebody else a week later to come in here. Does that make sense to you guys? If nobody's looking at it, I have a higher risk, so therefore I need to make wider markets as a market maker, and I'm not going to give you that edge. You're going to have to come to me. Whereas something like Intel, Apple, we showed you American Airlines, Tesla, all of those big name stocks, Google's, there's a lot of eyeballs in there, and those people are fighting for the best market. So now you have a real market. You know, somebody gives up a penny here. That guy sees you gave up a penny and stepped in front of him, he steps in front of you, and then all of a sudden that market comes together. That's what we're looking for, is a tight market for picking the right underlying. You may have the assumption and everything else for a particular underlying, everything else works, but the bid ask on this is maybe 50 cents wide on a, you know, $50 stock. Just walk away from it. There's other opportunities out there. Now, a stock over $100, my rule under $100 is 10 cents wide right here. Over $100. So let's look at Tesla, for example. I mentioned that a minute ago. Tesla, what we would want to do on a stock over $100, move the decimal place 3 ticks to the left, it's 27 cents, let's say. The bid to offer here should be about 27 cents. Tesla usually is. Tomorrow's a holiday and everything else. Weekends get a little funky because people cancel orders, but you want to look at that rule of thumb, move it 3 ticks to the left. That's how wide it would be. $1,000 stock would be $1 wide, right? So that's what we're kind of looking for this. What tool is this? Was that on this part, or when I accidentally popped it up with the analyze? That's the analyze tab, and for some reason I don't know why this is doing this unless they took that functionality away. simulated trading platform. I can't show the real trading platform because then it becomes like a, well, I may have to, but I can't show like results and stuff like that. So I try to stay away from the real platform so that it doesn't get misconstrued as investment advice versus the simulated trading is not real in a sense, quote unquote. But anyway, so next one is, I was getting ready to get on a soapbox, but I'm not going to. All right, so we picked the right underlying. That's the bid-ask width. Picking the right duration. Well, this is a lower probability strategy. We're collecting a credit. We want to get in and out of this quickly. And the way to get in and out of this quickly is to have that theta help us. Theta eats away at premiums. Well, if we sold premium, we want to eat it. We want it eaten away, right? If I sold it for $1, I want it to only be worth 50 cents because that's increased in value on my end. And that's what this is showing, the at the money call and the at the money put. This is what theta looks like on that option premium. The premium price, option price, the price goes down the closer. That's theta decay. And if we get inside of this money zone where we have a 50% drop in the premium value within this, 21-day time, 20 to 30-day time, that's what we want. We want this accelerated theta decay, and that's what's going to help us. So we want to get inside of, sometimes I'll say inside of 45 days to 35 days. Right now we're inside of 35 days, so it's pretty set up. It's setting up nicely, and we have really high implied volatility elsewhere. But picking the right strikes. Now, you guys might be looking at me and going, "Hey, Wolfman, you just said a straddle, and straddle's at the money. We already taught that. Is it over? No, it's not over, you guys." So I'm not going to do Tesla right now, but what we want to do is pick the at the monies, and that is our starting point, okay? You can skew it just a little bit here and there for directionality, but my idea with this one, there's better suited option strategies if you think it's really going to move away from where we are currently trading in the next 20 days or so. So for me, I look for something that has had some volatility. And what happens, we see these spikes, right? We see spikes and valleys on the charts. And then all of a sudden it comes to a point where it starts settling down. That's the timing we're looking for, is something where we think it's going to settle down. And if I think it's going to settle down, I think it's going to settle down right here, okay? And if I think it's going to move to a different place, then there's other better suited option strategies for that type of situation. So what we would look to do is, I'll just go to that example I already kind of gave away the hint to. What we want to do is we sell the at the money. So the current strike is closest to the 52 strike. Can we all agree with that? 52 is 4 pennies away from being at the money on the calls. So we'll pick the 52 calls and then sell the 52 puts. That's the straddle we're talking about, right? Then we want to define the risk. Now, this is a nice rule of thumb for coming up with, where do I define this risk? Well, we usually go out and pick the right around the 10 delta. We got a 9 delta here, we got a 13 delta here. It's pretty close. I would probably move to closer to define that risk, okay? If I'm having to do a pick 'em, we can check both of them, but I would look to pick one of these two on the put sides, and then on the upside, I would probably look at like the 10 delta on the 57s here, okay? So the idea is start around the 10 delta for your defined risk strategy. And the reason why is because that it's basically a mathematical thing that we have happening for us here, is that 10 delta ends up making this a risk one to make one. And what does that mean? Well, I make one by the premium I sold. So in this case, let's just go through it a little bit real quick. If I went to buy the 47s, that is $5 down, and I'm looking at $5 up to the upside to define that risk. It didn't click for me. So 57.50. Okay, so that's set up right. So then we want to collect at least 50% the width of the spread. Okay, it doesn't matter if it's call or the put. That's $5 wide, so 50% would be $2.50. That fits that rule. We are collecting over 50% the width of the strikes. Okay, so that's what we're trying to do. We sell the at the money, then we look to try and define that risk at around a 10 delta, and ultimately the deal breaker is going to be we want at least 50% the width of the strikes. Okay, so I know that's a lot to take in right there. Sell the at the money, picking the right strikes. We sell the at the money, call and put. That's the straddle. We're selling a straddle. And then we're defining that risk by going out and buying about a 10 delta option on the call side and the put side. That defines our risk. It's a defined risk strategy. Makes it appropriate for an IRA. Then we have to make sure we are collecting at least 50% the width of the strikes. Okay. So everybody got that so far then? Show the profit and loss graph, please, for the, yes, I will. I'll show that in a second. Tony, give me 1 second, profit loss graphs for the better visuals. I agree with that. But one of the problems was I was having when I was going into this is it seems like on this strategy, they're throwing that out there for me. And I don't know why that glitch is happening, but let's just see if I can do this here. All right. I'll just throw this over here. I'll just throw it over here. All right, so let's just look at this on the Analyze tab. Actually, let's look at this on the Analyze tab because I was just double checking to make sure there wasn't a glitch earlier. So our max profit is if the underlying trades right to here at expiration. That is the last day, all else, and we pin it right on 52. That's not going to happen, right, you guys? When was the last time you saw it at expiration? The stock was, you know, 52 even or even $50 even. It never happens. It's going to be a couple pennies here and there. So your max profit is really pretty unattainable, but it is in theory. So our max loss, excuse me, is that $2.66 if it goes down this way, $2.66 to the upside, and our max loss is $2.34. Sorry, max loss on this side $2.34 because it's the difference. We collected $2.66. The difference is $2.34, right? And our break even is the 52 calls minus, or sorry, the 52 calls. Sorry, what am I going here? The width of our max loss is the break even is what I was looking for that, right? Sorry guys, getting ahead of myself here, because I do have the platform set up for this in a second, but at the end of the day, to get the thing is the underlying price is the short call strike plus the premium. So our 52 calls are a short call strike plus the premium, which is $2.66. That should bring us to $54.66. Is that what that's saying? Close. And then to the downside, it's the same thing. We take the 52 call or 52 puts, sorry, and then we're subtracting the premium. So the 52 puts minus $2.66 gives us $49.34. Is that right? Off the top of my head, $49.34, something like that, right? So that's our break evens. That's how we figure all that stuff out there. All right. And I'm going to go over that on the slides here in a minute, but I did get a little ahead of myself. But one of the other things, so that's the picking the right strikes, defining that risk, picking that 10 delta, define that risk, making sure we get 50% the width of the strikes, okay? And then picking the right environment. We need to have high implied volatility here, you guys. The reason why we have high implied volatility during this is because those at the money strikes are going to be jam pumped full of premium. And that's what we want when we're collecting a premium, right? We want to collect the most premium we can because that's going to increase our probabilities. And here's an example. This is an old example because it's hard to find, believe it or not, a good example of a low implied volatility stock right now. But just take this for example, and I kind of squeezed this in here. This should be stretched out a little bit more, but I've tried to make it big so everybody could see it. EA Sports has really high implied volatility during this expiration cycle. It's trading at 119.05 in this example. We're picking the 120 strike. Now, if we pick the 120 strike, you can see that the premium I collected on this was on this defined risk strategy was almost, you know, what is that? $7 to the upside, 19 to 20, or maybe even $8 to the upside, and about 19 to 14. It's usually going to be a little bit skewed, but you can see that that's about $5 to the downside. So you've got a lot of wiggle room here. The idea is we're collecting 50% the width of the strikes, okay? But let's look at it on a low implied volatility percent. Now, Caterpillar is trading $5 less. Don't get me wrong. It's not apples to apples. It would have been trading at 19. But the fact of the matter is we aren't able to collect enough premium in this situation, which brings our break evens in closer. Yes, you do have the profit potential a little bit higher in this example, but you can see how narrow this is, which means that there is a lower probability of success. If I got to land, throw a dart and land inside of here, or throw a dart and land inside of here, where would you rather have your aiming point, right? Analyze tab is local to you. Mine works just fine. Okay. You know, I have been having problems with my platform lately. As a matter of fact, I lost my entire watch list and everything else at one point in time in all my charts. So that very well could be true. I probably need to call them up. But you can see the narrower, the higher implied volatility allows your break even to get further away. All right. That's the takeaway for picking the right environment. You want high implied volatility because you get fatter premiums for those ones that are at the money. All right. Knowing your exit strategy. How do we get out of this trade? Well, I mentioned it's a low probability strategy. Any lower probability strategy, I'm going to be willing to accept a little bit less. Also, we're going to collect a fat credit for this, right? So we don't have to take the whole thing. We don't have to be pigs. You know, on the floor, we used to say bulls and bears make money, but pigs get slaughtered. Meaning any market, a bull and a bear can make money, but the ones who try and squeeze it out too much are the ones that actually get hurt. So, and believe me, I've seen a lot of people make that mistake. So for this strategy, we're looking to take 25 to 30% of our max profit. And what does that mean? So we collected $2.60 in that previous example, right? So if we're going to be looking at $2.60, we want to take 30% of that. So how do we figure out where we get out? Well, we want to get out at 30%. Well, where would it be trading? It's just the opposite, times 0.7, and that will tell you we get out when it's trading around $1.86, okay? And the reason why that's a 30% reduction in that value is what we're looking for. Or this is 70% of the previous value, right? Which is also, mathematically speaking, 30% less in value. And that's where we're looking to get out. So 25 to 35% the value. Another thing you can look at, especially if you are very first time in on this trade, all right, very first time trading this strategy. This is days in the trade, and I should, you know, if you're less than 10 days in the trade and you're at 10%, you had a 10% reduction in that max profit, that's where we get out. 14 to 15, you know, less than 15 days, 15 days or less, 20%, 25 days to expiration, or 25 days in the trade, 30%, all right? We're not outside of that 25 days right now, and I'm probably not going to hold any of these strategies inside 7 days to expiration. There's just too many things that can go wrong there. I'm going to be looking to get out early and quickly. So this is another little chart that you can kind of go with to figure out when you should get out. And of course, when you're multiplying this, it would be times 0.90 on that premium. That's where you would get out, or 0.80 is where you're going to get out. Does that make sense to everybody, how you figure that out? You know, if I'm in this trade for, you know, let's say I'm in this trade for, you know, 14 days or maybe even 10, or let's say 11 days, just to get outside of that number. And my premium's 266 times 20% of max profit, which is actually times 0.8 to give me the number. So I'm getting out at around $2.12, maybe $2.10. I'd be happy to get out of that if it happens that fast. That means you got nice volatility crush. It's just kind of done nothing. You know, thank your lucky stars that you nailed it. I mean, as far as I'm concerned, you get any of these max profits inside of any of these days, you've pinned the tail on the donkey. All right. All right, so we can go over this real quick again. Max profit is the net premium received, well, minus commissions, but max profit's always on a premium selling strategy, that premium received. And our max loss is limited because it's a defined risk strategy. So how do we figure it out? Well, there's one of two ways. It's not really either or, but it's always going to be the same because the market can only go in one direction or the other, right? It can't go in both directions. It can't split and go up and down at the same time. So we take our long call minus our short call. So the width of the spreads minus that premium. That's what I was going over there before. So $5 width of the spread minus the $2.66 means our max loss is $2.34. Same goes for the width of these. They're the same width. We aren't doing a broken wing or anything like that. It is a equal distance butterfly. All right, so the short put minus the long put minus the net premium, you should come up with the exact same information there. Dates for dividends and earnings also impact this trade. Yes, they will. Dividends will impact this strategy in that, you know, usually the stock will, you know, this is all in theory, you guys. The stock is in theory on exit dividend date supposed to drop by the amount of the dividend. It doesn't always happen. Sometimes you'll see $1 dividend and the stock pops $1, goes up $1 on that ex-dividend date. It's breaking the trend. It's breaking the rules, but you know they're allowed to. But that's not always the case. It is in theory. And if the stock drops by said premium, then obviously your calls are going to be worth less because the market went down, and your puts are going to be worth more because the stock went down. You know, as the stock goes down, the premiums on the put side increase, and the calls decrease as the market goes away from those stocks and or towards those. All right. So it's just the width of the spread minus that premium we've received gives us our max loss. And then our break evens, I mentioned, is the short call strike plus the premium received, or the short puts minus the premium received. And we kind of went over that when we did the analyze tab. How can you handle this assignment process? This is at the money. Greg, so one of the ways I handle this assignment process, a lot of times if you are outside of 10 days to expiration, let me go find that, one of my charts real quick that I was looking for, this one. I don't like holding it inside of this here. There's different things that are going to be happening and I would suggest that, especially if you're an intermediate or newer trader, to not play around with these options inside of this 7 days. There's gamma, there's a lot of jockeying back and forth with the stock coming into that expiration, as everybody and their brother who has a lot more money than you or I are pushing that stock around to fit their books. I like to be out of that before that. And most people are not going to assign you further out here on the curve. Your probabilities increase as you go closer, but just stay away from this because this is where it usually will happen. If you do get assigned on it and somebody, you know, wants to be that guy, then you have defined risk. So you can always remember when you're selling premiums, you have to obligate. If you are the buyer, it is your right. So if somebody assigns you, you can just go out and assign somebody else. You will get a recording, Banu. You'll get a recording. Everybody's going to get a recording on this, and it should come out probably, you know, this weekend. You know, it takes me a little while to get everything together on this, and then get it sent out and everything else. But we try and get it out as fast as we can. So let's go through a couple. This is actually the time of the webinar where I usually throw it out to you guys, make this interactive. Give me a couple of stocks that you're looking at that you think, you know, we want this same market theory that it's going to trade sideways. It's just our assumption, you know. We don't know for sure, but we have an assumption and we've come up with that, and whatever it may be or however it may be, whether it's Fibonacci, maybe it's landed right between two Fibonacci levels and you're like, there's no way it's going to break out of these two Fibonacci levels, or you're using market profile or anything like that. Oh, somebody was Micron, I think was the first one that I saw. So let me try and pull this up and we'll go through it step by step. Let's delete that. So MU. So Micron is a $50 stock trading right around $52, right? So what's the first thing we do? We look at the first full month. And the reason why you look at the first full month is, you know, it's going to have the most participation. The big money is in the monthlies and things of that nature. So that's where we're going to want to stick, especially if we're a newer trader. We want to look at maybe volume and open interest. You can do that as well just to see what's going on. You can see Micron has all kinds of volume and open interest on any given day. The other thing we look at, which is the easiest, is bid offer. It's a $50 stock, so my rule of thumb is it needs to be about 10 cents wide, bid to offer. These are all fitting that rule. Does it have high implied volatility? We can go and look at the chart on it and see if my charts are going to work. So high implied volatility, we have this major spike out here on this one earnings event. And one thing I say with all of this stuff, like we've had really high implied volatility lately, right? And none of that super high implied volatility has even come close to this one spike on that one earnings. Now, I don't really know why that one spike happened there. Micron could have had some other news other than just the earnings coming out there, or was expected to. But one thing with the implied volatility is kind of, you can discount that. How do we figure out what the implied volatility percent is? My rule here is we have high implied volatility percent. That means for a stock, anything above 50, this is my implied volatility percent column. Any ETF above 30 is high implied volatility. The way to figure high implied volatility, if you don't have it on your platform, or you see something like this that is just an anomaly that won't ever happen for the next 10 years or something crazy, or even next 2 years, you can discount that and say that this seems to be about a place where it's the high implied volatility, right? So we could say that that is 65 there. And what we do to come up with this formula is the high, or sorry, where it's currently trading minus the low in the numerator. So we have a fraction, right? So in the numerator's on top, denominator's on bottom. The current, which is 47, minus the low, which is 30. So that difference is 17. So in the numerator, we have 17 divided by the sum of the high minus the low. Well, we're saying our high is here. And so that's 64 minus 30. So in the denominator, we have 34, right? So 17 divided by 34 is right there at 50%. But Micron, which I am sure I don't have on my list since I lost my watch list. That was one that, thank you, who was it, Greg, throwing that out there, reminding me about Micron. I tried to rack my brain for a couple of days on it. But if we look over here, it's going to say 29. So that might make one think, oh, well, it's really not 50%. Wolfman said we need above 50%. Well, if you have something like that, I do not have a problem discounting that. As a matter of fact, I know some traders that only do this high implied volatility percent for the last 6 months, and then they do all their math and don't look at the implied volatility percent given by the platform. All right. So that being said, this is 50%. Yeah, we could expect that. If it looks like it's trending down, right? We don't have any earnings. Now, you guys, I don't mind if you use this strategy for earnings because we're looking for that volatility crush. And what happens after earnings is you get that volatility crush. It's not one of my favorites, but you can hold it after or hold it through a earnings event. Now, my thing is I would like to put it on right before the earnings event. I don't like to put it on, you know, several weeks before, because as you can see, that's when you're usually getting your implied volatility to increase, and we don't want it to increase. We want to catch it when it's near the high, right? So we want the expectation of that volatility coming out, or that volatility crush, and it looks like Micron is in that direction. What is the horizontal blue chart on the right? BK, this horizontal blue chart here is called market profile. What it does is the blue shows the volume, the amount of contracts traded at any given price, and then these little tiny things that you can barely see in the background are the time nodes. And the time on the floor, you know, every 15 minutes we had a time change, and that's what's signifying here. When you have a time change, a new letter is placed in there. So the letters underneath are the time volume nodes. Right here, the yellow line is where the most time has been spent, and then the red is where the most volume has traded, the price. Okay, it's called volume profile on Thinkorswim in the studies. Yes, and monkey bars is the other one for the, I think, the dots there. It's also called Stottlemyre and things of that stuff. Stottlemyre is the one that came up with it. Yeah, I know, HH. Look at your prior webinars. Your watch list should be visible in the recordings, or at least most of it. That's true. And I did think of it that one time, but I've just not done that. I thought, you know, I thought I had it. and Greg had to prove me wrong. All right, so Micron Technology. So that I'm going to say it fits the rules. It's right at 50%, but it does have implied volatility going down. So I think that's a good setup there. 52, the idea would be that we think it's going to level out here, though, right? We don't think it's going to go anywhere. We think it's going to trade sideways. And I'm okay with that. So 52 is our strike that's at the money. So we're going to sell the 52 calls and then sell the 52 puts. All right, so there's our straddle. That is the quintessential short straddle. Actually, I don't want to do that yet. I'll do it all when it's one piece. And then we just kind of scan out here. Where's the 10 delta? All right, right there, 45. So that is $7 to the downside. So we want to define our risk with this one. And then let's just look at the 10 delta to the upside. What's the closest to the 10 delta? I like to keep them equal distance. So one thing I'm going to look at is $7 down. So I need $7 up is around where I want to go. And that's pretty close. Looks like we're just skewed to the upside a little bit. So $7 up, $7 down. We'll define that. And what's half? What? Why isn't any of this working for me? Define that one. Define it with that one. That's our 10 deltas. We've got $7 wide, so we need at least $3.50. And lo and behold, we get that. Right? $7 wide, what's my rule? We want to collect at least 50% the width of the strikes. $7 divided by 2 is $3.50. And we are $3.85, so we have exceeded that. All right, so that one works. You're going to be able to figure out a lot of these will work, even with low implied volatility. Sometimes they will work out nicely, but remember, you know, as volatility goes down, all these deltas start going down also. So we're able to get wider and collect a little bit better credit. And remember what I said, we want to get wider because that increases our probabilities of success. You know, if I was only able to, if I could compare apples to apples and this was a super low implied volatility strategy, you know, I might be looking at doing this as a $4 wide to get that 50% the width. Okay, we're able to get way out there. Okay, all right. Is it Noel said, I think NVIDIA. No. All right. So NVIDIA, let's delete this. NVIDIA, let's look at the charts. We can just kind of check it out. NVIDIA has high implied volatility. Doesn't have the earnings in this cycle we're looking at. You know, you could go further out and get into that earnings thing, but I would warn against that because I have a feeling before that you're going to see a little bit of this come out, and then probably right around here we're going to start seeing that start come up again. All right, that would be my worry here. Kind of like here, you still see it kind of coming off, and then you start ramping up into it. So we don't necessarily want to ramp up into it. But if we can catch this clean month, we'll be happy, I'm sure, or at least pretty sure. All right, so looks pretty range bound. It's stuck between my value area highs. The one's the value area high for the volume, one's the value area high for the time. Trying to think of which one I said first. All right, so idea would be to go in here. Where is it trading? $231. And so my rule is move the decimal place 3 ticks to the left, 25 cents. You can see NVIDIA meets that rule, 25 cents works. So we're going to be looking at the 230 calls and puts. Those are the closest. So we're going to go 230s, and then let's look for that 10 delta. Where is it? 200. So we're $30 wide for the 10 delta. So I'm just going to basically default $30 wide to the upside. Why isn't this working? I don't have to do it twice. All right, so 30 down, 30 up would be the 60 strike, which is right here, and that's a little bit higher than the 10 delta, but it's close, right? We want to keep these equal distance, so let's go with that one, and it'll probably make our math a little bit easier. All right, so we got $30 wide, and we've been able to collect at least 50% the width of the strikes. Okay, sounds good. Anybody have any questions real quick before I move on to the next example? No? All right, so I'll do one more real quick. Let's see, I did NVIDIA, I did Tesla wasn't looking, okay, so Chris, Tesla, I looked at Tesla earlier. I'm short Tesla, and I'm not gonna lie, I'm short Tesla. I'm actually long puts in Tesla, 2-year puts. But one thing to keep in mind, Tesla has been really wanky. There's a lot of stuff going on there that, you know, their bonds are now higher risk than the Ukraine bond and stuff like that. So I would just stay away from Tesla, only from my own theories and stuff like that in and around Tesla. So I'm going to skip on that one. So let's check out Facebook. When would you close out trading it if it immediately starts going against you? Well, it's a defined risk strategy for it. So I would say, because anytime there's a defined risk strategy like this, I'm going to kind of let it run out. if you have a lower risk tolerance, know where your break-even point is, like we talked about on these charts, you know, where you're basically taking the short strike plus the premium, or the short put minus the premium, and just look at it like that. You know, you could say, hey, if it gets outside of here, I'm pulling the ripcord. You can do that. I don't have a problem with it. I'm going to ride this out. Any defined risk strategy, I'm going to most likely ride out like that. So I would take the maximum loss on it. But you're going to be able to, you're going to have about a, if you're getting out where I say, and it's back of the math, or back of the napkin math, it's basically around a 76% probability of success when you're getting out at those premiums. So if you have a 76% probability of success, you're going to win. Okay. So where was I? Facebook, I think I was going to do. Does Facebook have high implied volatility? Really high implied volatility. That has to do with most of their news and the environment we've been around. So we can look at Facebook for sure. So let's pull up a Facebook trading window and get rid of this and do the Facebook. Okay. Let me get rid of that. All right. So Facebook, we're going to be looking at $160 stock, and we say it's $160 stock. So 3 ticks to the left, 16 cents wide, and no way, Facebook. Look at that. They're more than 16 cents wide. Usually Facebook is a nickel wide, you guys. And it generally fits the rule. So we're going to be looking at the 160 strike. So I'm just going to go with it from here. The 160 strike. So sell those. Sell the 160s. Where's the 10 delta? Right here. So we're at 140. Sorry, I have a bad habit of doing that, you guys. Where from the floor, like we would never say 140. What are the 140 puts? We would just say, what are the 40 puts? Or the, you know, we usually drop the front part of it. So wait, I want to do this again. So sell the calls, sell the puts, the 140s. We're going to be buying to define the risk. So that's, we've gotten $20 wide there. So I'm going to be looking at the 180s to the upside, which is right here. So let's look to buy those. So we got $20 wide, right? $20 wide to the upside, $20 wide to the downside, and we collected, all right. So it doesn't fit the rule there. We want to collect more. We want more of a collection than what we're risking because of the low probability. This we have to accept that. So I'd skip it. Can I? Farshid's asking now. Can I repeat how I determine the probability of this trade with the back of the geez, with the back of the napkin math that I've done basically is on the history of the trades that I've done with this iron condor. And it came out about a 76% probability of success. So I don't have anything like right now that I can give you statisticals, but what you can do is it's a long drawn out math process, but if you get out, the earlier you get out, the higher probability of success you will have. No magic hack on this one right now. No, sorry. No magic Wolfman hack. No. But that one I would probably stay away from, you know, unless, you know, you can always go up there and try and just work it for more. And that's one thing I always say, especially with your trading, always enter it slightly above the mid at a place where you don't really think you're going to get filled. Put it in because it costs you nothing to cancel replace, you guys. It costs you nothing to put this order into the market. If I cancel it, I'm good. So put it in there where you don't necessarily think you're going to get filled because you may very well, and then cancel replace it down to where you get to about the mid-market is where I would suggest, maybe a penny or two below, and then you're out, or then I would not chase it anymore. Okay, that makes sense to everybody? Does anybody else have any other questions? All right, I might be able to get you guys out of here on time today. All right, guys, this is the webinar for today, you guys. And one thing that's easier than writing all this down, if you're watching this on tape delay, just pause and type this into your URL. It's in, the easy way to get it is in the chat. One thing I say at the beginning with these webinars, you guys, this information is imperative to being successful. Generating income with options. That's what I've just talked about. That's generating that income when you're selling premiums and stuff like that. Protecting your portfolio with options. A lot of people have just stocks in there or even bonds. So the interest rates moving around are going to affect that as well. So I have a couple. This is over probably 10 hours of information for 36 bucks. So the best thing you guys can do to become better traders is to constantly learn, and obviously done that by taking this webinar. But one thing I say is, you know, put on strategies small. For instance, portfolio management with this on an iron butterfly. I don't care how sure you are that this market is going to trade sideways, you might not be right. So don't put all your eggs in one basket. You know, you don't want to have more than 5 to 10% of your portfolio value in any one strategy, okay? So play it small, get out early, and move on, all right? John, yes, there is a recording. I'm recording right now. So I gotta convert this, send it out. It's got to go through home office, then they send it out. So it does take a little bit of time, but it will work itself out. So take advantage of this, guys, for 36 bucks. You guys, I mean, it will pay itself off in the long run for sure. So go ahead. What do you say? Click on that box in the chat window and get yourself started with trading some more options. All right. That's all I got for you guys today. Other than I want to say thank you. Try to throw JQ off to see if I got him a little early. See if I get him jump. But anyway, just want to, later webinars, I'm going to be drilling down on different option components when and where I find trades appropriate. Here's the link again. You know, you can pause it, punch it in. It is not a hot link there. I just want to thank you guys all for watching. Any questions, you can contact us 310-598-6677, or you can email us at trading@protraderstrategies.com. All right? JQ, LOL, have a good weekend. Have a good weekend, guys. And everybody have a happy Easter. If you can't take that, take it easy. All right, guys. Bye-bye now.